Now I want to discuss some other important insurance terms. Let's start with what is insurance? Well, that's a pretty silly question, isn't it? Most people know insurance is a way to protect the things that are most valuable for them. Protecting your auto, your home, your health, your life. Those are all protected because you buy an insurance policy and you pay a premium to the insurance company, and when you have a claim, the insurance company reimburses you. And that's what most people think about when it comes to insurance. And insurance, though, is a little bit more technical when it comes to the traditional definition. So it's important to know the traditional definition for test purposes. The traditional definition is a method of handling pure risk by spreading it over a large number of individuals. Let me repeat that. The traditional definition of insurance is a method of handling pure risk by spreading it over a large number of individuals. So again, most of us know it as paying some premiums and in turn having a contract with that insurance company and the insurance company guaranteeing that they're going to cover us. But it's not only that, it's also that traditional definition of a method of handling pure risk, spreading it over a large number of similar individuals. Now, what is underwriting? Underwriting is the department where all of our applications go. Underwriting is the practice of the insurance company selecting risks that are going to produce a profit and rejecting those risks that will produce a loss for the insurance company. So it's important that they have a good underwriting process in place. When you buy an insurance policy, the application itself goes to the insurance company and it goes to an underwriter. The underwriter's job is to evaluate that risk, determine if it's going to be a risk that's going to produce a profit for the company or if it's going to be one that might produce a loss. So the underwriter has the decision-making ability to decide, is this one we want to keep or is this one we want to reject? And good underwriting practices are going to produce a favorable loss ratio. Favorable loss ratio simply means the premiums that come into the insurance company less the expenses and less the claims will produce a profit for that insurance company. Okay, so underwriting, it is simply a process, a department in the insurance company of accepting risks that are going to produce a profit and rejecting those that produce a loss or will potentially produce a loss in the future. Another term, arbitration. Arbitration clause in the insurance policy. That's going to be described in the policy as a process of bringing a contract dispute up before an objective third party for resolution. All right, arbitration is required in some states before mediation or litigation. So whenever there is a dispute between you and your insurance company, oftentimes it will have to go to arbitration, depending on the state law, of course, and depending on the contract. But arbitration is simply a process to bring a dispute between you and your insurance company to an objective third party for the resolution of arbitration or that issue. The assignment clause in an insurance policy. The assignment clause, assignment is simply transferring the legal rights of an insurance policy to another party. Most insurance policies are going to require that you get written consent of the insurance company in order to assign that policy to someone else. All right, so the insurance company controls that. They only want to give you permission with their written consent to transfer it to another party. And the reason for that is they don't just underwrite the item that they're insuring. For example, if I am selling my house to someone else and I say, I have a really good homeowner's policy, why don't I just transfer it to you? Well, the insurance company is not going to allow me to do that. They generally, not without their written consent, they generally will require me to, they will want to not only underwrite the house, but they're going to want to underwrite the individual. And so they generally are not going to allow me to transfer my house or to transfer my insurance policy, my homeowner's insurance policy, to someone else without their written consent. So it's important to know the assignment clause. You cannot transfer your rights, generally speaking, to another individual without the written consent of the insurance company. A binder. A binder is another term we sometimes hear in insurance and often on test. A binder is a legal agreement that's going to provide temporary evidence of insurance coverage. So a binder is temporary evidence of insurance. Oftentimes when you buy a home or buy a car, you are going to be issued a binder. And that binder isn't the policy itself. It's simply a form that indicates we have coverage as of right now, and it's generally for a temporary basis. So it's temporary evidence of insurability while the insurance company is going through the underwriting process to determine whether they want to accept or reject your risk. They are going to give you a binder. And so again, a binder is temporary evidence of insurance coverage until the policy can be issued. A certificate of insurance. Sometimes in our business we love our acronyms and our initials, and this one's often called a COI, Certificate of Insurance. That contains a general summary of the policy. It is not the policy itself. It's just a summary of the policy. So if you want to prove that you have auto insurance, it is going to be a summary of your auto insurance. Oftentimes states are going to require you to have some kind of proof that you have auto insurance in your car. If you're going to remodel your home, for example, and you ask the contractor to prove that they have insurance in case they cause damage to your home while they're remodeling it, that proof of insurance is a certificate of insurance, and that is simply giving you, the homeowner, a general summary of what the contractor's insurance policy has in it. And that is called a certificate of insurance. It's just a general summary of the insurance policy. A coverage form versus an insurance policy. All right, a coverage form is often used to build an insurance policy. The policy is the policy itself, but a coverage form is going to be used to build an insurance policy. Oftentimes when you have a commercial package policy, you might have multiple different coverage forms underneath that commercial package policy. A commercial package policy might contain a commercial property coverage form. It might contain a commercial auto coverage form. It might contain a commercial general liability coverage form. Each of those separate coverage forms fit into a commercial package policy to create the package policy. You could buy each of those items individually as standalone policies. Then they won't be coverage forms because they'll be outside of a package, but they would be individual policies if you had them separately. But the benefit of having them on a package policy is oftentimes you're going to get discounts, but it's also a little bit more convenient for the customer, easier to understand when you have them all within the same package. So a coverage form is simply a coverage part underneath a package policy. And just note that those coverage forms are not any different than the standalone policy that they represent. So if it's a commercial auto, for example, if you bought a standalone commercial auto, it would have exactly the same coverages, exclusions, and so on. But if you put it under a package policy, it is a coverage form. Okay? Thank you.